Hello and welcome to Simplicity in Stocks. Did you know that less than 20% of traders in the stock market make consistent profits? That's right. As per many market studies conducted over the years, more than 80% of traders lose money in their trading activities over the long term. What about the remaining 20%? Well, most of them don't make too much profit, certainly not enough to sustain a good lifestyle. In fact, only about 1% of all traders in the world make sufficient, consistent profits to fund their lifestyles over the long term. And how many among this 1% actually become rich from trading? Well, only a small fraction of them. But there's no reason to be disappointed. The stock market offers a simple way to beat the odds and make a lot of money. You need to become a long term investor. In this regard, here's a quote from Warren Buffett, the world's richest investor. The stock market is a device for transferring money from the impatient to the patient. The stock market rewards those who successfully apply the rules of long term investing. But first, it's important to understand that no matter how great your effort, investing success does not come overnight. It's one of those things in life that takes time, discipline, and patience. Now, with that out of the way, let's get to how you can become a successful long term investor. Just remember that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now, let's get to how you can become a good long term investor. The first thing you should know is the difference between investing and speculation. You can't become a successful long term investor if you don't know if you are investing or not. So, here's the definition of investing by the Dean of Wall Street himself, Benjamin Graham. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are termed as speculative. In simple words, putting your money in a stock which has a good financial track record and is trading at a decent valuation is an investment. On the other hand, putting your money in a stock that's loss making or even paying too high a price for a good quality stock will qualify as a speculation. Okay, now let's dive into the 5-point checklist for long-term investing success. First, debt. It's always a good idea to start with debt levels of a company that you are considering for investment. This is especially the case for non-finance companies. Ideally, a manufacturing or a services company should have little debt or should be debt-free. Many fundamentally strong stocks have zero debt. Use a screener to screen for stocks that have a debt to equity less than 1. Ideally, the debt to equity should be less than 0.5. Also, it's a good idea to look for companies that are actively reducing their debt. While a company may have some debt today, you shouldn't worry about it too much as long as it's consistently reducing that debt. Finally, compare the debt with the cash on the balance sheet. A huge amount of debt along with low cash is a big warning sign. The opposite is what you should be looking for. 2. Dividends. Next, you should check the dividend payout. Many investors ignore the dividend and focus on capital gains. This is a mistake. The best companies in the world have a long track record of dividend payments. This is because fundamentally strong companies have rock solid cash flows which they pay out to shareholders as dividends. Whenever the stock market falls, dividend paying stocks are always in high demand. This is because investors prefer the safety of the cash flow that dividends provide over capital gains. These stocks can also provide a good dividend yield. The dividend yield of a stock is its dividend per share divided by its current market price. Investors tend to compare dividend yields to bond yields or bank FD rates to get an idea of the attractiveness of a stock. Fundamentally strong dividend paying stocks can provide good yields during a market correction. This is because they tend to fall initially along with the rest of the market, but as the share price falls, the dividend yield goes up. As soon as the yield becomes attractive enough, investors jump in and buy them. This means high dividend paying stocks have an inbuilt stop loss. Among dividend paying companies, some companies raise their dividend every year. They are called dividend growth stocks. In these stocks, you get the benefit of capital appreciation as well as rising income from dividends. So, this is the best of both worlds. 3. Growth. Screen stocks for good growth in both sales and net profit. 15% plus growth in sales and net profit over the last 5 to 10 years is what you should screen for. The higher the better. Companies that maintain good sales growth and profit growth during a stock market downturn will be in demand. The market knows that these high growth stocks are essentially getting cheaper most of the time. This is because the high growth increases the earnings per share (EPS) at a fast pace. A rapidly growing EPS combined with a falling market makes these high growth stocks very attractive. At a certain point, deep pocketed investors will start buying these stocks. This buying activity can stop the fall in the stock price or can even reverse it. Fast growing stocks attract the attention of big investors sooner than slow growing stocks in a market correction. Just keep in mind that it's a waiting game with high growth stocks. These stocks rarely trade cheap in terms of PE or PB ratios. If you invest too soon in a high growth stock, you may end up buying it at a high valuation. This could result in losses. But if you are patient, the stock market will present you with a golden opportunity to buy these stocks at a great price. 4. Past track record. While no investor makes profits in the past, it's still important to look at the past as a guide. If a stock has done well in the past, it's worth checking out if it was driven by fundamental reasons or by speculation. If the reason was strong fundamentals and those fundamentals are still intact, you could have a multi-bagger stock on your hands. Just be sure to buy it at a decent valuation, that is at a reasonable PE or PB ratio. 5. Return on equity. The return on equity or ROE is one of the best measures of a high quality company. A sure way to find a high quality company is to look for high return on equity along with low debt. This is a great combination to look for in your screening process. You are bound to find stocks with solid fundamentals. All great long-term stocks have a good ROE. If you rigorously filter out the low ROE stocks, you will inevitably get a list of stocks with high ROE. Just be sure to use it along with other metrics like high growth and low debt. Also, always compare ROEs of companies that are in the same industry. Well, there you go. With this 5-point checklist, you will be ahead of about 90% of investors in the stock market. You can consider it as your guide to become a successful long-term investor. What do you think of this checklist? Share your thoughts in the comments, and thank you for watching.